Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 154. And in this episode, we are reviewing the performance of the global markets during the 14th week of 2025, and that is from Monday, the 31st of March to Friday, the 4th of April. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where on Friday, the Labor Department released the latest employment report, which showed that the growth in jobs was stronger than expected in the month of March, which provided temporary reassurance that the labor market remains stable. According to the Bureau of Labor Statistics, nonfarm payrolls increased by 228,000 new jobs in March, up from the revised 117,000 jobs in February, and better than the Dow Jones estimate for 140,000 new jobs. Despite this, the unemployment rate ticked up to 4.2%, which was higher than the forecast rate of 4.1%, as the labor force participation rate also increased. Even though the headline jobs number came out stronger than expected, this unemployment report was released against a highly uncertain backdrop, and this was after President Trump implemented his tariff plan on Wednesday, which has intensified concerns about a global trade war that could negatively impact economic growth. And staying in the United States, according to the latest CNBC rapid update policy, rising uncertainty and new sweeping tariffs from the Trump administration are combining to create an outlook for stagflation in the U.S. economy. For your information, stagflation is a term used to describe an economy experiencing a combination of stagnant economic growth and persistently high inflation at the same time. The data projects that economic growth in the first quarter of 2025 will come in at an anemic 0.3%, compared to a robust growth of 2.3% in the fourth quarter of 2024. Over to the Eurozone. According to flash data from Eurostat that was published on Tuesday, the annual rate of inflation in the Eurozone dipped to 2.2% in March and was just 0.1% lower than the final reading of 2.3% for February. Meanwhile, the core inflation rate, which excludes volatile food and energy prices, this also edged lower to 2.4% in March, down from 2.6% in February. Recent interim data has shown that March inflation came in lower than forecast in several major Eurozone economies. For example, in Germany, where inflation fell to 2.3%, whilst the inflation in France remained unchanged at 0.9%. This latest inflation data has boosted expectations for a further 25 basis point rate cut from the European Central Bank during its upcoming policy meeting that is scheduled for Thursday, the 17th of April. Following the release of the Eurozone inflation data, markets are currently pricing in about an 80% chance for a 25 basis point reduction in the policy rate, which now stands at 2.5%. On Wall Street this past week, the stock market plummeted for a second day on Friday after President Trump implemented his aggressive tariff policy on Wednesday. The new tariff plan sent shockwaves across the financial markets and fueled speculation of a global trade war that could push the global economy into a recession. The top 7 technology stocks, also known as the Magnificent Seven, were the hardest hit by the stock sell-off and shed a combined $1.8 trillion in market capitalization over the past 2 days. Technology stocks such as Apple slumped by 7% on Friday, bringing its weekly loss to 13%, whilst Nvidia pulled back by 7% during the session and Tesla fell by about 10%. A quick overview of the 3 major stock indices shows that the Dow Jones Industrial Average fell by about 1,680 points on Thursday and lost another 2,230 points on Friday, which was the biggest decline since the COVID-19 pandemic in June 2020. Meanwhile, the S&P 500 nosedived by 5.9%, which was the biggest decline since March 2020, and the tech-heavy Nasdaq Composite dropped by nearly 6% on Thursday and was down by a further 5.8% on Friday, and this takes the index down by 22% from its December record, which translates into a bear market in Wall Street terminology. In the Treasury bond market, the yields on U.S. Treasuries continued to plummet on Friday following China's retaliation against President Trump's tariff policy, which caused investors to flood into safe haven assets such as U.S. Treasury bonds, and this was driven by rising fears of a global recession. Over the past few days, investors have been shifting their portfolios into the perceived safety offered by U.S. Treasuries and in the process have raised prices and pushed yields lower. Following Trump's announcement on Wednesday, China returned the favor on Friday by slapping a 34% tariff on all goods imported from the United States. Federal Reserve Chairman Jerome Powell said that Trump's tariffs could lead to higher inflation and curtail global economic growth. The chairman also noted that the central bank faces a highly uncertain outlook, but indicated that policymakers are ready to stay put on interest rates until they receive further details on the impact of the tariffs. At its peak earlier this year, the yield on the benchmark 10-year Treasury bond topped 4.8%, but has now hit its lowest level since October 2024 as it dropped by 4 basis points on Friday to close at 4.01%. Meanwhile, the yield on the policy-sensitive 2-year Treasury note shed 5.5 basis points to trade at 3.67%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the crude oil market, the price of crude dropped to its lowest level since 2021. sparked in part by concerns that the tariffs announced by President Trump on Wednesday have raised the probability for a global recession. The swift drop of oil prices comes as both supply and demand are getting heat from both sides. On the demand side, the ongoing tariff war is likely to lead to a slowdown in global economic growth, which translates into reduced aggregate demand for crude oil. And on the supply side, 8 members of the Organization of Petroleum Exporting Countries and its allies have agreed to raise their daily output of crude oil by 411,000 barrels per day. This combination of subdued demand and increased supply is what is currently pulling down the price of crude oil. At one point, the price of the U.S. benchmark West Texas Intermediate crude fell below $61, and this came after a drop of 6.6% on Thursday, followed by a further decline of 6% on Friday, to bring the price per barrel to $62.72. In the precious metals market, the price of gold fell more than 3% on Friday, erasing gains from earlier in the week as investors sold off bullion to cover their losses from the wider market meltdown. Global stocks fell for a second consecutive day on Friday, following the back and forth tariffs, mainly between the United States and China. Despite the dip on Friday, gold is still up by about 15% so far this year, driven mainly by central bank purchases, plus its overall appeal as a hedge against geopolitical and economic uncertainties. Despite volatility in the markets, gold remains a safe haven asset for most investors and tends to thrive in a low interest rate environment, given that it doesn't pay off a regular coupon like a bond. For the week, the price of gold was down by 1.9%, but had initially hit another record high of 3,167 on Thursday, before correcting to close the week at $3,024 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling continued to trade sideways versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.25 compared to 129.37 that was recorded the previous week. Meanwhile, the sterling pound was priced at 169.23 and the euro was valued at 141.50. And on the regional front, one Kenya shilling was changing hands for 28.22 Ugandan shillings and 20.43 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.91. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves decreased by $20 million for a grand total of $9.93 billion, which is equivalent to 5.1 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the central bank does not provide any explanation for the change in foreign exchange reserves. In the money markets, the interbank market was sufficiently liquid during the week and was also supported through open market operations, which remained quite active. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this was relatively stable at 10.68% compared to 10.66% the previous week. And in terms of volume, the average value that was traded in the interbank market, this decreased to 6.8 billion shillings, down from 12.2 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 23.1 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 3rd of April, and the central bank received bids totaling to 40.6 billion shillings against an advertised amount of 24 billion shillings, representing a performance of about 169%. The central bank ended up accepting almost the entire amount at 40.5 billion shillings, and the results of the auction were as follows. The 91-day rate declined by 16 basis points to average out at 8.62%, whilst the 182-day rate dipped by 2 basis points to level off at 9.03%, and the 364-day rate was a shade lower by 2 basis points to settle at 10.38%. In the primary bond market, the auction for the monthly Treasury bond issuance was held on Wednesday, the 2nd of April, and the central bank received bids totaling to 71.7 billion shillings against an advertised amount of 70 billion shillings, representing a performance of about 102%. The central bank ended up accepting almost the entire amount as it took in about 71.4 billion shillings, and the results of the auction were as follows. The first bond, which was a 15-year bond issued in 2020 with 9.9 years left to maturity, the central bank accepted 20.8 billion shillings at a weighted average rate of 13.66%, compared to the bond's coupon rate at 12.75%. The second bond was another 15-year bond that was issued in 2022 with 12.1 years left to maturity. The central bank accepted 17.9 billion shillings at a weighted average rate of 13.82%, compared to the bond's coupon rate at 13.94%. And the third bond was a 25-year bond that was issued in 2022 and which has 22.6 years left to maturity. Here, the central bank accepted 32.5 billion shillings at a weighted average rate of 14.23%, compared to the bond's coupon rate at 14.18%. And in related news, the Monetary Policy Committee is set to meet on Tuesday, the 8th of April, in order to review the outcome of its previous policy decisions and recent economic developments and to decide the direction of the central bank rate. In its previous meeting that was held on the 5th of February, the Monetary Policy Committee decided to cut the central bank rate by 50 basis points to the current rate of 10.75%. And given that both inflation and the exchange rate continue to remain stable, and with the central bank committed to bringing down interest rates, we expect the committee to announce another reduction of 50 basis points. At the Nairobi Securities Exchange, during the first quarter of 2025, the equities market was on an upward trajectory with the NSE 20, the NASI, the NSE 25, and the NSE 10 gaining by 10.8%, 6%, 3.8%, and 3.1% respectively. The market's performance during the quarter was driven by gains recorded by large-cap stocks such as Stanbic Bank, DTB Bank, and NCBA Bank, which increased by 17.9%, 9.8%, and 8.9% respectively. These gains were, however, weighed down by losses recorded by other large-cap stocks such as Cooperative Bank, Equity Bank, and British American Tobacco, which declined by 2.7%, 2.5%, and 1.3% respectively. Up next is our topical issue, and this week we're looking at the decision by the Ministry of Agriculture to import about 5 million bags of maize. Maize is one of Kenya's most vital staple foods and is the lifeblood of many households and also contributes a significant portion to our national economy. The significance of maize cannot be overstated, given that Kenyans consume approximately 4 million bags of maize every month, which translates into 48 million bags per year, with a staggering value of around 250 billion shillings, positioning maize as our most traded commodity. Depending on weather conditions, the domestic annual production of maize is estimated at between 20 to 30 million bags, which creates an annual deficit of about 20 to 30 million bags. Despite all the development we have achieved as a country, it is a crying shame that 62 years after independence, Kenya still cannot feed itself, and the issue of food security remains a major concern. Due to the persistent deficit in maize production, the price of white maize has increased by about 26% since December 2024, and this has negatively impacted most households that are reliant on maize as their main staple food. The Ministry of Agriculture noted that growing competition over limited maize stocks is what had led to the sharp increase in the price of white maize over the past 3 months. A market analysis by the Kenya National Bureau of Statistics shows that in March 2025, a 2-kilogram packet of maize flour was retailing at an average price of about 165 shillings, which was a 14% increase from October 2024 and was the highest retail price over the past 13 months. It therefore comes as no surprise when just last week the Ministry of Agriculture announced that it was authorizing the importation of 5.5 million bags of yellow maize to help ease the pressure on the price of white maize. The Cabinet Secretary for Agriculture said that the state would grant a 50% duty waiver for the importation of yellow maize for the next 1 year. And to further cushion Kenyans from the impact of rising maize prices, the Cabinet Secretary said that the government would authorize the release of white maize from the National Food Reserve, specifically to millers producing maize flour for human consumption. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please consider supporting this podcast by becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, discipline is the ability to prioritize the needs of your future self over the needs of your present self. Think about it. Thank you, and God bless.